Here is a summary of Wells Fargo's Q3 2025 earnings call transcript, designed for clear and concise delivery. Wells Fargo Q3 2025 earnings call summary introduction. Today, we're reviewing Wells Fargo's third quarter 2025 financial results. The call features CEO Charlie Scharf and CFO Mike Santomassimo, who will discuss performance, future outlook, and key strategic initiatives. Key financial highlights. Revenue increased by 5% year-over-year, benefiting from growth in both net interest income and strong fee-based revenue. Net income and EPS both grew compared to a year ago and the second quarter, driven by investments made in prior years. Loan growth accelerated in Q3, showing increases from both the prior quarter and the previous year. Credit performance remained strong and continued to improve. Capital return. Wells Fargo increased its common stock dividend and doubled share repurchases from the second quarter. Return on tangible common equity, ROTCE, reached 15.2% in Q3. The company is now targeting a medium-term ROTCE of 17% to 18%. CEO's key statements. Charlie Scharf. Momentum and growth. We are very happy with our third quarter results. The momentum we are building across our businesses drove strong financial results. With the lifting of the asset cap, we are now on a path to grow more broadly. Transformation progress. We have worked in parallel to transform and reposition the company by changing our business mix and how we manage the company, and this has resulted in significantly improved returns and margins. U.S. focus and scale. Wells Fargo is a U.S.-focused bank benefiting from the nation's economy. Scale is a key advantage, with top 3 positions in many core businesses. Asset cap lift impact. The lifting of the asset cap is enabling growth in balance sheet-intensive businesses. Total assets exceeded $2 trillion for the first time. The company is actively growing trading-related assets and re-accelerating checking account growth. Growth aspirations. Wells Fargo aims to be the top U.S. consumer and small business bank, wealth manager, and a top 5 U.S. investment bank. They expect all businesses to generate returns comparable to best-in-class competitors. Capital position. Significant excess capital is available, with a CET1 ratio managed around 10% to 10.5%. This excess capital provides flexibility for growth, economic volatility, and shareholder returns. CFO's key statements. Mike Santomassimo. Q3 financials reported $5.6 billion in net income, a 9% increase year-over-year, with diluted EPS of $1.66. This included $296 million in severance expenses. Net interest income, NII, increased by 2% from Q2, driven by higher loan and securities balances and asset repricing. However, net interest margin, NIM, declined 7 basis points due to growth in lower-yielding trading assets, which helped the markets business. Excluding markets, NIM would have been flat. Loan growth drivers. Commercial and industrial loans in corporate and investment banking, securities-based lending, credit card, and auto loans saw growth. Consumer loans grew linked quarter for the first time in over 3 years. Deposit trends. Average deposits declined year-over-year primarily due to a reduction in higher-cost corporate treasury deposits. However, deposits grew from Q2, reflecting increases in corporate treasury, wealth management, and investment banking. Non-interest income increased 9% year-over-year, driven by strong performance in wealth and investment management and investment banking. Expenses. Non-interest expense increased 6% year-over-year, primarily due to severance, higher revenue-related compensation in wealth and investment management, and increased technology and advertising spend for growth initiatives. Credit quality. Net loan charge-offs declined year-over-year and sequentially. Commercial net charge-offs were stable, with lower C&I losses offset by higher CRE losses. Consumer credit quality remains resilient. Capital and liquidity. CET1 ratio remains strong at 11%. $6.1 billion in common stock was repurchased in Q3, with similar levels expected for Q4. Outlook. Full year 2025 NI expected to be roughly in line with full year 2024 NI of $47.7 billion. Q4 2025 NI expected to grow from Q3 to approximately $12.4 billion to $12.5 billion. Full year 2025 non-interest expense now expected to be approximately $54.6 billion, up from earlier guidance, primarily due to higher severance and revenue-related compensation. Q4 2025 non-interest expense expected to be approximately $13.5 billion. Management forecasts for future quarters. Medium-term ROCE targeting 17% to 18%. CET1 ratio managing to 10% to 10.5%. Q4 2025 NI projected to grow to $12.4 billion to $12.5 billion. Q4 2025 expenses projected at approximately $13.5 billion. Share repurchases. Fourth quarter repurchases expected to be roughly in line with the third quarter. Significant risk factors. Macroeconomic environment, interest rate fluctuations, inflation, and broader economic conditions remain key influences. Regulatory environment, continued adherence to an evolution of regulatory requirements. Execution risk, achieving ambitious growth targets and efficiency improvements requires effective execution across all business lines. Credit risk, while currently strong, potential for future losses in specific portfolios, particularly commercial real estate. Highlights. Successful lifting of the Federal Reserve's asset cap, enabling balance sheet growth. Strong revenue growth, particularly in fee-based businesses like investment banking. Accelerated loan growth and improved credit performance. Increased capital returns to shareholders through dividends and repurchases. Clear path outlined for achieving higher returns, 17 to 18% ROCE, through organic growth, efficiencies, and optimized capital. Significant progress in reducing expenses and streamlining operations. Lowlights. Net interest margin, NIM, declined slightly due to strategic growth in the markets business, which carries lower immediate yields. Full year 2025 non-interest expense guidance was slightly increased due to higher severance and revenue-related compensation costs, though these are linked to growth initiatives. Continued revenue declines in commercial banking and commercial real estate, though progress is being made to stabilize and improve these areas. Most important statements from CEO and CFO. CEO Charlie Scharf emphasized the company's transformation, the significance of the asset cap removal for growth, and the clear aspiration to become a top-tier U.S. financial institution across multiple business lines. He expressed excitement about the company's improved position and future prospects. CFO Mike Santomassimo provided a detailed breakdown of the Q3 financial performance, highlighting key drivers of revenue and expense. He outlined the company's updated financial outlook, including NI and expense projections, and reiterated the strategic importance of efficiency initiatives and capital optimization in driving future returns.